The hype around artificial intelligence has never been bigger. Every headline, every investor pitch, and every tech conference seems to have one word stamped across it: AI. From text generation to image creation and now full video synthesis, the excitement feels unstoppable. But behind the glossy demos and trillion-dollar valuations, cracks are starting to show, and the warnings are no longer coming from skeptics on the sidelines. They're coming from major financial institutions. The International Monetary Fund and Bank of England are the latest financial institutions to warn that global stock markets could be in trouble if investor appetite for artificial intelligence turns sour. In other words, even the world's top financial authorities are sounding the alarm. The AI boom that's fueling today's market frenzy could easily become tomorrow's bubble burst. Let's start with OpenAI, the company at the centre of it all. OpenAI generated about 16% more revenue in the first half of 2025 at $4.3 billion than it did a year ago. The information reported on Monday, although the artificial intelligence major continued to burn large amounts of cash in its operations. OpenAI burned $2.5 billion in cash in the first half, the information report said, citing financial disclosures released to shareholders. The costs were largely associated with AI development and running the company's flagship ChatGPT software. OpenAI spent about $6.7 billion on research and development in the first half of the year, the report said. OpenAI made a massive $4.3 billion in the first half of 2025, more than double what it was earning a year ago. Sounds great, right? But behind the headlines, the numbers tell a different story. According to the information and Reuters, OpenAI burned through $2.5 billion in cash just to keep its operations running and poured roughly $6.7 billion into research and development. Add in another $2 billion for sales and marketing and billions more for data centers and GPUs, and it's clear that the company is spending far more than it's making, a burn rate that would make even veteran tech investors nervous. When a company consistently spends more than it earns, it's living on borrowed time. This kind of imbalance can't be sustained forever. It may look manageable for a while, especially if the company has deep pockets, around $17.5 billion in cash and securities as of mid-2025. But even that cushion won't last forever. Analysts warn that at its current pace, OpenAI could need fresh funding in the next 12 to 24 months just to keep the lights on. Spending more than you make might fuel short-term growth or hype, but in the long run, it's a financial red flag that often ends in layoffs, restructuring, or collapse. This is where the story starts to look less like a rocket ship and more like a bubble inflating fast. OpenAI isn't alone in doing this. Its growth is intertwined with another tech giant, Nvidia. In late September 2025, Nvidia announced plans to invest up to $100 billion in OpenAI as part of data center build-out, a mind-blowing number that require millions of GPUs. For context, that's nearly double Nvidia's annual GPU output. This move raised eyebrows across the tech world. Nvidia, after all, is both a supplier and now an investor in OpenAI. It sells the GPUs that make OpenAI's products run. And now it profits from OpenAI's success in another way, by holding equity. But there's a risk here. This kind of circular investment structure can look a lot like the dot-com era, where companies invested in each other to keep valuations inflated. Nvidia sells chips to OpenAI. OpenAI buys more chips. Nvidia reports record earnings. OpenAI's valuation climbs, investors cheer, the feedback loop keeps spinning until it doesn't. It's a pattern that feels eerily familiar. During the late 1990s dot-com bubble, tech companies were pouring money into each other's stock, inflating valuations that had little connection to real profits. Everyone wanted a piece of the internet revolution, and investors believed growth alone justified sky-high prices. Startups with no revenue were going public overnight, their share prices doubling or tripling on hype alone. But when the market realised that excitement wasn't the same as earnings, the bubble burst, wiping out more than $5 trillion in market value and sending hundreds of companies into bankruptcy. The parallels to today's AI craze are hard to ignore. Soaring valuations, circular funding between hardware and software companies, and a belief that limitless growth will solve every financial problem. The question now is whether history is about to repeat itself, or whether this time the technology truly lives up to the promise. When OpenAI closed its $6.6 billion share sale in October 2025, the company was valued at $500 billion. That puts it on par or even ahead of major public corporations like Netflix and ExxonMobil. But here's the problem. Netflix makes 5 times the revenue OpenAI does, and unlike OpenAI, it's profitable. Netflix brought in about $21.5 billion in the first half of the year, with a net margin of nearly 30%. So what justifies that $500 billion valuation? Investors are not betting on current profits, but on the promise that AI will one day reshape the entire economy. That might happen. No one has a crystal ball, and no one truly knows how much AI will revolutionize the world or the future of work. But history is clear on one thing. Bubbles form when valuations rise faster than financial reality can support them. In September 2025, OpenAI released Sora 2, the latest version of its text-to-video model, and once again social media erupted. Videos of realistic cityscapes, cinematic scenes, and animated characters flooded X, formerly Twitter, and Reddit. Tech influencers declared that Hollywood was about to be disrupted. Investors piled in, pushing AI-related stocks to new highs. But those who actually tested Sora 2 painted a less glamorous picture. The model is indeed more advanced than before, with smoother motion, better lighting, and more realistic faces. But according to early testers, the model still suffers from serious consistency problems. Characters morph unpredictably, physics break down, and prompts often produce dozens of unusable clips before one even looks right. And there's still no way to edit a generated clip. Want to change one object or tweak one line of action? You have to rewrite your prompt and hope the model gives you something new that's close enough. For a commercial studio, that's a nightmare. So while the internet sees a few viral clips, what they don't see are the thousands of broken ones behind the scenes. The technology is impressive, but it's nowhere near replacing professional production pipelines yet. There's also a legal elephant in the room: copyright. Multiple lawsuits are already underway against OpenAI and other AI companies, filed by organisations like the New York Times, alleging that their models were trained or copyrighted material without permission. These lawsuits are moving slowly, but they could redefine how AI companies operate. If courts rule that training on copyrighted works without consent constitutes infringement, the cost of retraining these massive models could skyrocket. Some analysts say it could wipe out years of progress and billions in valuation overnight. So far, regulators and lawmakers have been cautious, but as the public becomes more aware of how these systems are built, pressure for action is growing. And history shows that once legal precedent catches up to technology, it can change industries fast. Another big issue: compute costs. AI models like GPT-5 or Sora 2 require enormous computing power, not just to train, but to operate. Each time a user sends a prompt, the system doesn't just process it once, it runs multiple internal queries, checks itself, and generates a final output. That process is expensive. As models get more advanced, they also get more computationally hungry. That means the cost of running them keeps increasing, not decreasing. The usual rule of economies of scale doesn't apply here. In 2024, OpenAI spent around $2.3 for every $1 it earned. In 2025, that figure climbed to $2.6. In other words, the bigger the model, the bigger the losses. This is the opposite of what investors want to see. For most tech companies, scaling up reduces per user cost, but for AI, scaling up is making everything more expensive. Then there's the energy problem. The AI industry is now one of the largest new consumers of electricity in the world. Every new data center needs power, cooling, and maintenance. According to industry analysts, OpenAI and its partners are consuming energy at rates comparable to small countries. The trend is exponential. Microsoft, which hosts much of OpenAI's infrastructure, has already warned that power constraints could slow down expansion in certain regions. Nvidia's GPUs, meanwhile, are selling at 4 to 5 times their pre-boom price, and yet they still can't meet demand. So when people talk about scaling AI to billions of users, they're ignoring a basic bottleneck: physics. There's only so much power and silicon to go around. And yet none of this seems to worry investors. The S&P 500 recently hit record highs, driven largely by AI-related stocks. Nvidia's market cap soared past $3 trillion and semiconductor stocks dominate the index. Analysts are calling it the biggest single-thing rally since the dot-com era. The Shiller price to earnings ratio, a measure of how expensive the market is relative to historical norms, recently crossed 40. The last time that happened? Right before the dot-com crash in 2000. Back then, everyone believed the internet would change everything. And they were right. The internet did change the world, but not before most of those overvalued companies went bankrupt. AI might be on the same trajectory, the technology is revolutionary, but that doesn't mean every AI company is a good investment. For every Google that emerges, there are dozens of pet.coms along the way. AI is supposed to make everything faster and cheaper, but so far there's little evidence it's boosting productivity on a macro scale. In fact, recent US productivity data from mid-2025 shows only a mild uptick despite massive AI adoption across industries. Some economists are calling it the new productivity paradox, the same phenomenon seen in the 1990s when computers became widespread but took years to translate into measurable economic gains. AI tools like ChatGPT, Claude and Gemini make individual workers faster, but many businesses haven't yet found ways to integrate them efficiently. Some reports suggest that large companies spend more time experimenting than actually saving money. The hype may be real, but the returns are still theoretical. If this all sounds familiar, it should. The same story has played out many times before. In the 1920s, it was radio and automobiles. In the 1990s, it was the internet. In the 2010s, it was crypto and blockchain. In each case, the pattern was the same. Revolutionary technology, early success, euphoric speculation, and eventually a brutal correction. The underlying innovation always survived. Radio didn't die, the internet didn't die, but the bubble did. AI is likely heading down that same road. The technology is here to stay. It will change industries, reshape jobs, and drive the next generation of tools, but that doesn't mean today's valuations make sense. The truth is, markets can only stay disconnected from fundamentals for so long. When companies are losing billions while being valued at $500 billion, something eventually gives. The first warning signs are already here: slowing revenue growth, skyrocketing costs, legal risks, and infrastructure bottlenecks. If interest rates stay high or investor sentiment shifts, the rush into AI stocks could reverse just as quickly as it began. And when that happens, it won't mean AI is over, it will just mean the hype is. Investors will finally separate the signal from the noise, the real innovation from the speculative cash burns. The companies that survive will be the ones with sustainable business models, real-world applications, and long-term discipline. The AI boom of the 2020s is shaping up to be one of the most transformative periods in modern history, but it's also following a very old script. Right now, we're in the euphoria stage, where optimism drowns out skepticism, where every startup gets funding, and where losses are dismissed as temporary investments. But eventually, gravity always returns. OpenAI, Nvidia, and others have built astonishing technology, but they've also built expectations that may be impossible to sustain at this pace. Revenue growth alone can't justify a market that's burning through cash faster than it can raise it. The AI bubble might not pop overnight. It could deflate slowly. Like, comment, and subscribe if you found this breakdown helpful. Stay tuned for more deep dives into the economy, markets, and technology right here on Eureka.